Hey you guys, Freaky Finance here. Just filmed the Airbnb video, and now we're gonna do Crocs. So totally different. I do own this one as well. I did show it on the Airbnb video, but I should show it again. So Crocs position, before we jump into it, I own it there, and then I own it here as well. So it basically sold out very hard in earnings. We've seen footwear in general. Maybe I'll do a video on footwear companies. So Nike's under pressure. All these companies under pressure. Calares, DBI, Crocs, right? We've seen a lot of weakness in footwear, right? Shoe Carnival. Some of them still have high multiples. Some of them have very cheap multiples. Basically, the market's decided shoes are being cut. So that means we're going to see opportunities. So that's why Ackman's probably a Nike, right? Though, I mean, he just, if you listen to what he published, he actually decided to ride it with call options instead of holding the position, which is interesting. And I don't think we know how long duration the call options are, but I just thought that was worth pointing out. But anyway, Nike is also in my hit list to look at some point, because given the brand, but it never trades at a multiple that's generally that cheap. Like Crocs was trading at 6 times before the move, right? So especially when we're gonna go through the numbers and be like, really, that was at 6 times, and it could come back to 6 times again. Like, this is a special business in terms of footwear. Before we jump into the numbers, should point out, like, some people might not know what Crocs are. This is what they are. They're shoes, the footwear. Relatively cheaper footwear, and usually easy to. Usually so the selling points are that they're personalization, so you can they're kind of customized to you if you want. You can also put your custom, like they call them giblets on them. That's a new thing that you can put on there, almost like not necessarily charms on your shoes, but more ways to customize your footwear for things that you like or are passionate about. And they're also very comfy. So they're cheap, comfy, and you can personalize it. So they cross the 3 things that you need for shoes in the long run. And they've kind of been polarized with Crocs has actually embraced in their marketing, right? Because some people view them as super ugly and other people swear by them, right? So it's very polarized, and Crocs has taken advantage of that. Sourcing, so this is one of the reasons why I think we're seeing deals in certain things, like if they have exposure, perceived exposure to APAC region, right, with Trump. So that could lead to opportunity. I'm hoping that leads to more opportunity in companies like this that are great businesses that I can just buy on some type of fear that never actually happens, or if it happens, it's overpriced. So anyway, Crocs is actually predominantly in Vietnam. And we saw this actually, a good example to bring from COVID. We saw a lot of manufacturing move out of China because of Chinese policies, right? And the shutdowns, and they kept them in shutdowns. And like, well, we got to make things, so we got to move. And a lot of them moved to actually Vietnam. We saw that in a few companies that we looked at. The Vietnam name just kept coming up every call. So anyway, I think Crocs was already there beforehand. They do have exposure to China, so they also have third-party manufacturers in Indonesia, India, and Mexico, right? So it's not like they're not going to have tariffs. But it's just worth bringing up where the things are sourced. So that's on their recent 10K on page 10. This is just a good visual of kind of how their business breaks out. So you're going to see Hey Dude, which we're going to harp on a bit on the call, and then Crocs. So 80% of the enterprise is Crocs, though in my mind, this is where the value is. This is where they did a misstep, which the market is giving us 6 times earnings because of that. So I think that's why we're getting the deal. It's because of Hey Dude, because the core brand of Crocs is far superior than what it was 5 years ago. We're going to look at what far superior means, because I don't use that lately. Like, it's night and day how crazy Crocs is right now relative to just 5 years ago. So a lot in the DTC channel and a lot in wholesale. So very mixed here. DTC we like more because you have more control on inventory turns. Here, North America, relatively diversified. I would say that Crocs is still very underpenetrated and international, and you're going to see that in some of the growth numbers that we're seeing out of China even. Just very low presence still in the world, despite, say, a lot of like Canada, North America. I would say very well known, probably one of the most well-known brands there are for shoes now. Partially because of how they marketed them as being ugly, but cheap and comfortable. So this is just shows the international opportunity, just how underpenetrated they are. And I thought this was fun too, that they have more market share in South Korea than they do in US and UK. But that's beside the point, right? We're talking about here. You have like no market share in China, France, Japan, right? Very limited in India and Germany. We're talking like 1 to 2% market share, and they already do $4 billion in sales, right? So there's a huge market for shoes. The Crocs growth rate, there's a reason why it's growing like it is, because it has such a superior product. We talked about in the last video when we did Crocs, I believe knockoffs are probably the biggest risk. There's still a big risk. You can buy Croc-like shoes on Amazon, right? So that's always going to be a big risk. Though it is interesting that their China growth is still so high when a lot of the sourced knockoffs are in China. So that's just worth bringing up. So if I were to see the knockoffs trying to start slowing more, or say that they lose share, that'd be a big red flag. But okay, there's some knockoffs taking off in China, which are probably going to start showing up somewhere else as well. I thought this slide was interesting too. The operating margins, and you're going to see this when we go through the annuals, are just special. They're the same as Birkenstocks, which is pretty surprising. I actually think they can get more out of these operating margins if they want to. But you can see in terms of Skechers, which we've owned in the past, the operating margins on these Crocs are very high. It doesn't take a lot of cost to produce them, and yet they can still sell them very cheap, unlike their competitors, which could sell them at $100, $200, $300 shoes, right? Buying Crocs for $50. Sometimes you can get them for $30, right? Sometimes $20. They're trying to blow it out. So anyway, that's worth bringing out. We can jump through the numbers pretty quickly here. So here's the annuals, and you can see the revenue growth is just crazy, right? Over the last 6 years, 1.2 billion to 4.1 billion. Now the caveat here is here. You had COVID, which was a winner, so people stayed at home more. They actually bought shoes, comfortable shoes they could wear. So Crocs actually picked up share, and then they decided, with all this extra cash, let's buy something. So I think they're under pressure to keep the growth rate going, because you have this crazy high going from 11% to 66% growth rate, right? So crazy shoot up in growth, right? And I think they felt pressure to keep that growth rate going. So what they did is they made an acquisition. So this was organic, and this was inorganic growth. So they did a Hey Dude acquisition. It's actually a big acquisition for them at the time. And you can see that it kept the growth rate going. Now you're going to see a lot of red in this column because it basically shot up the balance sheet. It lowered the operating margin of the business in terms of a gross margin percentage. It lowered the inventory turns. We're going to go through it all right now. So anyway, longer term, you can see the GMD going from 600 million to 2.4 billion in 6 years. Right, that's 4 times in 6 years. And the SGA going from almost 500 to 1.4 billion. So we have seen the company spending more in SGA. They actually guided that again in 25. They've been supporting the brand of Crocs more. So generally, usually this could be a good or bad thing. It depends on why they're supporting the brand. So Hey Dude has been very weak, and so they're trying to basically stop the bleeding. And so that's showing up here on this line. Now, ultimately, you can see the GMD growth and the operating income's still pretty strong, but you can see it kind of flatline over year, right? And that's partially why we're getting the deal. And I also think there's a risk here that some of what they overpaid, you can see it in intangibles here, specifically goodwill, which we just view. I should do a video one time on Kraft Heinz and how much they impair all the time. Other brands, it's consumer packaged goods companies. But anyway, Hey Dude should probably already be impaired. The fact that they haven't impaired it is wrong, or in my mind, it should have been done. So we'll likely see impairments at some point here, non-cash impairments, but it's worth bringing up there. You're gonna see. I would hope that they should, unless they turn it around. But in my mind, they made a botched acquisition. Goodwill by itself, in my mind, just means you overpaid for something, right? It's the premium that you paid to take out the net assets. That's just how I treat it in my head. So basically, I view intangibles as like a time bomb for write-downs. So we haven't seen that part yet of the intangible write-downs. You can see how much it shot from 30 billion. So it grows organically for years, decades, and then they decide this, and you can see it just shoot up the intangible assets. And that was more than the tangible assets. So they kind of blew up their balance sheet here, and they did that. So they made the acquisition by taking on debt. So you see this here going from 180 million in debt to 771 million in debt to 2.3 billion in debt. So huge step up in debt during those 4 years. This debt in 21 was actually them taking on debt to buy back shares at a time when their shares were already really good because they just had a growth acceleration, right? The COVID win. Like they literally saw a 66% growth rate. And they're like, you know what? It's a great idea. Let's take on debt and buy back shares. And the shares were already high because the growth rate was high. And so it was just dumb decision into another dumb decision. And so the market probably hasn't been in a penalty box till they're like, well, stop making dumb decisions and just give us the cash that Crocs is making and keep investing in Crocs. Like, why are you fooling around with brands where you obviously don't understand them, right? You obviously, like, there's a reason why it's declining year over year for every quarter, right? Like, you obviously have something going on good with Crocs, but you don't know how to manage another shoe brand, right? So that's what the market's saying. I think that's why we're able to get it at 6 times earnings. There could be something here where the market somehow thinks Crocs is going to give up what it's gained, like the core brand, which would be more of a red flag, but we haven't seen that. All we've seen is performance out of Crocs. So that's something on my radar. Like if Crocs were to start faltering or maybe something happens, maybe knockoffs just take share. But in my mind, they're positioned very well in footwear because of where they're priced. Like I said, price, comfort, and personalization. So very, very interesting spot for footwear, I think. And I do think we're getting a deal in footwear right now, like I mentioned at the very beginning of this video. We are seeing the diluted share count finally start coming back down again. So we're buying back shares pretty good, and then they made this acquisition and the buyback stopped. And now what they're doing lately, because you can see the earnings are pretty high and the free cash flow is very high, they are starting to pay down debt as well. So they're not only are they buying back shares, but they're fixing their problem that they made. So the balance sheet's starting to come down now, looking very good. So basically the free cash flow is going to debt pay down and share buybacks, which is nice, right? Especially at 6 times earnings, right? So these things are great. So I'm hoping I just see more of this over time, especially the buybacks, as well as the deleverage. And you're starting to see the deleverage show up in interest expense as well here, right? So you can see it shoot up from 20 million to 135 million to 160 million, right? So this is when they levered up. So levered up to buy shares, then levered up again to buy HeyDude. So now they're fixing it. You can see it actually down 50 million year over year, which is nice, right? Income tax is just noise. So you're going to see GAAP earnings shoot all over the place. Doesn't look very consistent. I think that's also obscuring the strength of this, right? Where it's very consistent. Like you can tell the business is far superior than what it was 6 years ago, right? Now the market obviously knows that as well. It's $42 back then. Now it's at $100, but it's, in my mind, it's like this thing could be a sleeper. Like they could do this again, right? 10 years from now, this could be 8, right? This could be materially better, right? So it's just, I think it's just positioned very well, and they're finally fixing their problem. Though I think they should have probably impaired their horrible HeyDude acquisition, but we'll see. Maybe they can turn it around. They keep saying they will, and then all we see is the sales declines, right? So here, I just put acquisition of HeyDude here just to see what it costs on their cash flow statement. So $2 billion, right? And you can see a lot of that was intangibles. So, and 700 million, I think, was in goodwill itself. What else? And you can see the debt pickup here and the debt pay downs here. You can see the buybacks over the last 6 years. I mean, they bought back more than $2 billion, $2.1 billion in 6 years, which is nice, right? Especially for a company that's only worth 6.2 billion, right? So the buybacks I think are special, especially as the share price gets cheaper. So we keep seeing the share price shoot down, and then I mean, this time the earnings were nice, so it shot up. But we've been able to play the earnings pretty well on Crocs, and the business is very clear. It's very easy to understand. So, and the financials are very easy too to read. So, what else is there to bring up? We did see part of this inventory push. I think we're seeing the turns actually get better again. So, inventory turns, the higher, better. So, where you're turning your inventory, you're seeing that 4.7, 4.4. So, this is really good. It's also helping cash flow when inventory is not going up as quickly as sales is. So that's why inventory is here. You can see inventory, the bloated inventory from HeyDude. They deal with it and they deal with it again. So they're almost through their inventory cycle, which is nice. That's what I look for, because usually this means that they've been pushing out inventory to get it to move. And when that stops, it starts building. Well, we'll see. It builds for the right reasons. Basically, you want to make sure that it's building in line with sales or better. And so for this quarter or this year and this quarter, it looked really good. So they're managing their inventory really good right now. So they got a lot of, what I mind, the impairments to move the product, the HeyDude product, out of the way, finally, right? So that's what this would kind of imply to me. EPS, I mean, it's gone from almost, it's funny how much it's grown. It's gone from 130 million in net income. So its net interest expense is almost what it used to make a year. That's how much it's grown in 6 years. So it's just, in my mind, it's kind of special. CapEx, this is something I like to look at, right? You can see the PE kind of. Shoe companies generally don't get that high of a premium. Like Nike's kind of an outlier, unless you're really, like, they do for temporarily. If they're like kind of like a fad or the growth rate's really high, they'll get some high PEs. But usually they're like the 10 or 12 range, right? So it's nice when you get Crocs at like a 6.5, right? Especially when the business has literally gone from 600 million in GMD to 2.4 billion in 6 years, right? So 4 times the business in 6 years in terms of gross margin dollars generated, right? So I like that. So the valuation is still relatively cheap even after the crazy move up that we saw. But again, shoes are still out of favor, so maybe we get another deal next quarter when the quarter's not as great, right? It's hard to time these things, but all you have to do is buy great businesses when people sell them to you. CapEx here, you can see in terms of their efficiency with CapEx, it's actually gotten better. So you can see it around the 10%, 12%, 16% range. The average there's 12. So 7% this last year. So pretty good CapEx spend. A lot of the free cash, you can see it here, right? So you generate 992 million. You only have to put 70 back in the business. Your free cash flow is pretty high. And that's what's driving these debt repays and the buybacks. So basically the free cash flow is going to these two things. And in terms of EV to operating income, kind of like an even a proxy, it's just sitting around 7. So still cheaper relative to its long-term average, but right, well, this is when it was bid up because of the growth rate was high, and now the growth rate's lower, and we're getting a better EV to OI multiple, right? Which is nice because the cash flow is so high that we're getting more bang for the buck on the buybacks finally. Well, the balance sheet's finally getting better. So I like that. The Crocs setup looks really good in the long run. The guide was kind of in my mind, kind of like May. Right? So we're seeing, again, you're seeing good Crocs revenue growth, but you still have Hey Dude is putting up crap numbers. Like, we're going to have a crap Q1 again, right? So it just shows like they really stumbled and fumbled with Hey Dude. And they should have just focused on Crocs, right? This is what they do because they've shown that they can't acquire and tuck in another brand. It's literally still shrinking year over year, right? It's putting an impact on overall growth rate. So Q1's guided to look kind of weak in my mind, and then they're trying to say like the back half of the year is going to be better. We'll see if that's true or not, that cadence, but it might give us an opportunity in Q1, though they are guiding to it to be pretty bad. So we'll see. But again, you're getting a grower whose growth is still impaired by a bad acquisition. So that's why we're still getting, in my mind, a good multiple, right? And the good thing here is that the free cash flow is there. So the buybacks can take advantage of this weak multiple. So I like that. I did think this was interesting on the call. They basically said that they're going to have an uptick in marketing expense again, going from 9% to 10% of revenue. So again, they're still spending more. We saw this on the annual for 24 as well. They're spending more on marketing to promote their brands, both Crocs and Hey Dude. So they are trying, and they don't break out how much they're spending to support Hey Dude, which so far has been a mistake. That I also think is making investors be like, well, how do I know that you're not just throwing money at something that you've already thrown money on? That's bad, right? Like how much is actually going to the core Crocs business, which is actually pretty strong, right? It has really strong margins, has strong growth rate, strong value proposition, whereas a lot of investors would be like, hey, dude's just another shoe brand, right? That's currently shrinking. I mean, the guidance was still pretty strong, right? You're almost at $13 EPS, right? So the fact that it was at $88, right, was nice, right? So, and the free cash flow is there, right? And it's showing up, like it's coming to shareholders, which is nice. I thought this was really interesting. And this just shows how underpenetrated they are in international. International grew 19% year over year, right? China grew 64% on last year's triple digits, so more than 100% growth rate. So China's finally showing up. And that's what I want to see, because if I'm afraid of knockoffs, I don't think they're going to grow that well in China, where the knockoffs are created. So that's exciting to me, because that's kind of like my fear, is that the Crocs core business gets worse, right? Then I'd get like this thing could go from 6 times to 5 times or 4 times, right? Who knows how cheap someone could sell it to me. But that's in my mind the longer term fear. But so far it's not happening. In terms of the core business, looks really strong, right? Crocs is strong. It's just worth bringing that up because I just view it as crazy, right? Western Europe still grew 18%, and that's with like crappy economies, right? It's not like things have been amazing for shoe companies, right? There's a reason why they're all hitting like close to 52-week lows, like Nike and all these other companies, right? People are pulling back on discretionary things. They'll stretch out the life of their shoe if they need to, right? Or they'll buy less of them. This is just them. They're basically 75% of the free cash flow is going to share purchases and 25% to debt pay down. We think that mix is what we're going to keep doing. We did upsize the share buyback, so they can buy back quite a bit, but I like this mix. I mean, the debt's not even that high anymore, right? Relative, like they're bringing in $1 billion in free cash flow. I mean, if their debt's at 1.3, and I mean, if they pay off another 25% of that this year, right, you're basically down to 1 times EV to debt, which is relatively low. Like I've seen shoe companies in 4 or 5 times EV to debt, right? So in my mind, the balance sheet is not immaculate like it was pre Hey Dude. It's getting there, so I'm not worried about that. And I am excited that they're using a lot to buy back shares because the shares are dirt cheap at the current free cash flow generation that they're getting. I thought this was interesting in terms of where they're spending SG&A. They're spending a lot on TikTok. So they're saying they're seeing really good results when they advertise on TikTok. I mean, that's what they're seeing in Asia, particularly China, where consumer spending is shifting from digital marketplaces to social marketplaces. So I just thought that was interesting. So again, we're going to see higher marketing, but I think we're also going to see higher growth in places like China because of it. And you can kind of see this here. Marketing spend probably several years ago used to run 7%, and now we're playing at 10%. Again, they don't kind of break out how much of that is to support Hey Dude versus the core business, right? And that's what I think investors are trying to understand. It's like, are you throwing more bad money after a bad investment kind of thing, right? Or are you focusing on building the Crocs brand, which I think is superior? Anyway, I like to know your thoughts. I kind of harped on Hey Dude a bit. I mean, I've seen penalty boxes before, and sometimes it takes years to get out. Like AT&T was like poster child of bad decisions, right? And we were able to get that all the way down. This is like reoccurring steady revenue. We were able to get AT&T at 6 times earnings during the lead panic, right? And that was like in my mind like a free like 7% divvy and like a 50% capital return in like, I don't know, 18 months. So we've seen what media can do to things. Crocs is kind of interesting. At the end of the day, it's a shoe brand, but I just think it's positioned very well. We've kind of talked about it enough times, so I've already wasted enough time on it. But just the value proposition, right? So being very cheap. So during times, if people are going to trade down in what they're going to wear, Crocs is generally pretty cheap. And then it's customizable if you want it to be like, you can, whatever you're passionate about. You have hockey teams, you can buy hockey Crocs, right? Any type of IP. There's a lot out there, and then you can customize it even further with those little giblet things. So, and then the comfort. So they're very comfortable as well. So when you have those three things, generally you're going to do well in the long run. And it's severely underpenetrated, like we saw in that chart, like 1% of market share, right? Not even 2% in US and UK, right? So shoes are very fragmented. There's a lot of choice in shoes, right? And it can be very finicky, but I just think Crocs just has a lot of room to run, especially in places like China, right, or France. And I just thought it was funny that South Korea is actually a place where they have the most market share. Or at least on this chart anyway. But anyway, I'd like to know your thoughts on Crocs, and have a great long weekend.